So we're going to look at consolidated financial statements. Now, we've only got so much time. I don't like have a million hours. So what I'm going to do today is talk about a few things to do with consolidated financial statements, but mainly looking at the consolidated statement of financial position, and then we'll probably do another session that looks at the consolidated profit and loss statement. So that's ultimately what got planned for this evening, in about an hour, hopefully. So by the end, hopefully you'll be able to define what we mean when we talk about control, and therefore under what circumstances do we need to look at consolidated statements. And then be able to prepare workings for these things called goodwill, non-controlling interest, group retained earnings, because we need to be able to prepare those workings in order to be able to draft a consolidated statement of financial position. And we'll talk about some of the common errors that occur when people try and consolidate financial statements, some of the things that people do wrong, and some of the things that, if you do them correctly, are quite easy marks on the exam. So first thing we want to look at then, what's the concept of consolidated accounts? Why do we do it? What's the whole concept behind it? So if we start just right at the very beginning, so we've got a company, and we'll just for simplicity point of view, we're going to just call it P Limited, parent limited, They buy shares in another company, and we'll call that company S Limited. Then P Limited would record that into their accounts as a debit to investment and credit to cash or bank or however else they paid for the investment. So got an asset related to the investment, and we've reduced either a bank asset, a cash asset, or by the amount of the investment. Now, the key thing to say at that point is there's absolutely no impact on the accounts of S Limited, because P Limited has bought the shares, and the shares are owned by the owners of S Limited, not by S Limited itself. So there's no impact on the accounts of S Limited. That cash wasn't paid to S Limited, it was paid to the shareholders of that company. So the transaction exists between in this case, P Limited and the owners of S Limited, not S Limited itself. So you'll see lots of things mentioned when we look at consolidated statements around this concept of control. So what exactly is control? Well, most people think it's about shareholdings, and it almost is, but there's lots of other things that can demonstrate control over other companies. So control is a mix of power. So do they have the power to be able to appoint directors? Do they have power to control decision making within that business? Do they have the ability to get return on investment? So, is there the ability for them to influence the level of returns they get from their investment? And then do you have the ability to direct that business in certain directions? And together that forms this concept of control. Certainly from an AAT perspective, and generally out in the big bad wide world, holding more 50% or more of the ordinary shares would define what's known as control. So I know there's lots of people think that, if you've got 50% of the shares, you don't have control, because really you need 51%. From an AAT perspective, as long as you own 50% or more, then you exercising a level of control over that business. Now, realistically, if you owned, I don't know, say 40% of the shares of a company, you could argue you've got control over the company, because you could be the majority shareholder, right? You could own 40% and they could be 1,000 other people that owned the other 60%. So you might have a control, you might be the largest shareholder, but you don't have overall control here because the other 60% could vote against you and ultimately don't have control. So using our example of S Limited and P Limited, so remember P Limited has bought some shares in S Limited. So S Limited would be treated as if it was a separate department of P Limited rather than a completely separate entity. So that's the idea of consolidated accounts. You're almost going to consolidate the two things together, and S Limited just be treated as if it's a department existing within P Limited. Now, obviously, that's almost against what we've learned up to now, which is that limited companies are separate legal entities. Because we still have P Limited, we still have S Limited. They are two separate limited companies. So as it says at the bottom of the slide, in strict legal terms, they remain distinct legal entities. What we're saying is that in economic substance terms, they're regarded as a single unit, which is where this concept of groups comes from. So you talk about groups of companies. It's ultimately lots of limited companies, existing under one group. So one company owns shares in lots of other companies. And they're regarded as a single economic unit. So there's some definitions. So as with everything in level 4, especially in this unit, it's all about international accounting standards and international financial reporting standards. So there is IFRS 10. And IFRS 10 is all around consolidated accounts. So consolidated accounts are covered in IFRS 10. And that has two definitions. One around what is a parent company, and then what is a subsidiary company. So a parent company or a parent entity is the entity that controls one or more other entities. So you can look in I put a link there. I will upload these slides onto the group later. There's a link there which takes you to IFRS's website, gives you the whole detail of IFRS 10, but all of the IFRS and IAS standards. So we've got the parent company, and then what we've got subsidiary companies. A subsidiary is an entity that's controlled by another entity. The key words there, controlled by. So it's controlled by, so subsidiaries, generally speaking, it's only a subsidiary if you own 50% or more of the ordinary shares in that company. Otherwise, you wouldn't consolidate it you wouldn't consolidate it. So, for example, if you own 30% of another company, then there's no need to consolidate, and you wouldn't consolidate the 30% into your parent company because it's not a subsidiary. It's only a subsidiary if you control it. So you've got 50% or more. So if you own 60% of the shares, then you would go down the route of consolidating the accounts into a consolidated group position. So that just builds on a little bit more of what I've said there. So it's this whole concept of a single economic entity. And the key principle is the need to reflect the economic substance of the relationship. So the parent controls 50% or more of the subsidiary. So parent P, subsidiary S. Once we've consolidated, we've got a group position. And as it says, the objective of consolidated financial statements is to show the position of the group as if it was one single economic entity. So in extremely simple terms, and we'll get into some of the detail in a minute, in really simple terms, 100% of the assets and liabilities of both P and S should be included in the consolidated statement of financial position. So the consolidated statement of financial position should include assets and liabilities of both of those companies, percent of the income and expenses of both P and S are included in the consolidated statement of profit or loss. We'll look at the detail of it, but the first starting point is 100% of the assets and liabilities should be included in the statement of financial position, and 100% of the income and expenses included in the consolidated statement of profit or loss. Now, if I left it there, everyone would think this is really easy. Let's just add them up. Let's just take the statement for P, take the statement for S, and add them together, and jobs are good. And well, sort of, but not quite. It's a little bit more to it than that, which will show as we get into slightly more detail. So I mentioned IFRS 10. We also have another accounting standard when we're looking at group accounts and consolidation, known as IFRS 3. So IFRS 3, business combination, that's what standard covers. And that defines this thing called non-controlling interest. And non-controlling interest represent the equity interest in the subsidiary that's not attributable to the controlling party or the controlling interest. So what we're saying is, if I own 70%, somebody owns the other 30%, and that 30% is not controlled by me, the parent company. Yeah, but there is a value to that bit of the company that I don't own. Yep. So as it says, the second paragraph says, the mechanics of consolidation require that 100% of the subsidiary's assets and liabilities are added to the parent company. And the really important bit, the bit that's bold and underlined, is this is performed regardless of the parent's actual shareholding. So I could own 55% of the company, or I could own 95% of the company. Yeah, and we are still going to do the same thing. We are going to consolidate 100% of the subsidiary's assets and liabilities and add those to the parent. Yeah. And then the bit that we do after that is we make the adjustment for non-controlling interest. So an amount is then calculated and disclosed within the equity section showing the non-controlling interest holding in the subsidiary company. So we're almost going to consolidate as if we own all of it. Yeah, so as if we own that entire subsidiary. We're going to consolidate on the basis we own 100% of it, and then we're going to adjust for the bit we don't own. Yeah. So, don't know why that's in there, because that slide's from last week. Look at that. Right, so we're going to jump into looking at consolidated statement of financial position then. So we've set a bit of a picture around what it is we need to do, why we need to do it. I'm just going to start to look at the first of the consolidated statement. So we're going to look at statement of financial position this evening, and then in another session we'll look at statement of profit or loss. So the key slide is this next one, which is the basics of consolidation for a statement of financial position. So it's a 5-step process, and lots of things in accountancy. It's just a process. Yep. So step 1, you're going to take the assets and liabilities of the parent company, and then take as it says, the assets and liabilities of the parent and the subsidiary, add them together in full on a line-by-line basis. Yeah, so that's quite simple. Doesn't matter how much of the subsidiary I own. Yeah, you're going to take all the parent's assets and liabilities, all the subsidiary, just literally add them together. Yeah, and then on the parent's financial statements, you're going to have an investment line that shows the level of investment that you've made in the subsidiary. So you're going to cancel that investment that's shown on the parent's financial statements against the addition of a subsidiary's assets and liabilities at the date of acquisition, because they're almost the same thing, right? Yeah, because you're making an investment, ultimately, you're making an investment to buy the net assets of the subsidiary. Now, yes, as we're going to come to step 3, you may pay more than the net asset value. So the net assets might be valued at £1 million, you might pay 1.5. But ultimately what you're doing is you are buying the net assets of that business, yeah, or a percentage of them, yeah, and you may overpay for that. That overpayment's known as goodwill. Yeah, so that brings you to step 3. Yeah, a goodwill asset's calculated and you include that within non-current assets. So that's if you've paid more than whatever the net asset value of the subsidiary is, then that additional payment is goodwill. Goodwill can be things like paying for reputation, customer list, good reputation, and we'll look at what goodwill really is in a short while. Step 4 then, once you've calculated the goodwill, the net assets of the subsidiary that are attributable to a non-controlling interest are calculated and shown in the equity section of the consolidated statement of financial position. So that's the bit that we haven't bought, the bit that we don't own. Yeah. So can we calculate what the net assets are that are attributable to someone else? Yeah. And then step 5, we want to be able to calculate the group's share of the subsidiary's post-acquisition profit. Because ultimately, any profit before we acquire the subsidiary doesn't belong to us, does it? Yeah. And then all of the profit after acquisition doesn't belong to us. The only bit that belongs to us is a proportional share of what we own. So the group's share of post-acquisition profit is calculated and added to group retained earnings because that belongs to the shareholders of the parent company. Yes, the parent company is invested in this subsidiary business. That subsidiary business has generated some profit. We need to know what share of that profit belongs to the parent, and that's ultimately added to the retained earnings of the group for distribution to the group shareholders. Yeah. So that's just a 5-step process. Now, I'm going to show you a little picture of generally what it looks like. Yeah, and a few sort of notes along the way. So we're going to look at how we calculate goodwill in detail. We'll look at that in a minute. But we're going to calculate that goodwill line. Yeah. And I'm going to calculate our other assets. So the value of all our other assets. Now, not split here into current assets and non-current assets. I've just called them assets. Now, obviously, in the real world, you would have non-current assets, current assets. But the principle's the same. You're going to take 100% of the parent's assets and 100% of the subsidiary's assets, add them together, and then make any what's known as fair value adjustments. So if you can adjust them up and down depending on whether the fair value of the assets is higher or lower than what they're reflected at in your statement of financial position. So that's almost revaluing the assets. So that's saying, we're going to go through some revaluation of a particular asset at the point of acquisition. We're going to revalue the assets and say, well, actually, they're in our accounts at £1 million, but actually they're worth 1.5. We're going to make a fair value adjustment for that. So obviously goodwill is a type of asset. We'll look at exactly what type of asset in a minute, but goodwill plus the remaining assets added together to get total assets. We then can move into our equity section. So equity made up of share capital. Yeah, and I know, share you can have share capital, share premium. But but ultimately the share capital and share premium of the parent company, just the parent company, that sits in the equity section, because we don't own all the shares in the subsidiary, do we? Yep. We own the shares in the parent company. So share capital of the parent company. Then we want the retained earnings. So 100% of the retained earnings of the parent, and then the parent's percentage of the subsidiary's post-acquisition profit. Now that is not, and this is where lots of people get lose marks, is they know what the parent's percentage of the subsidiary is. So what they do is they look at the retained earnings, the entire retained earnings for the subsidiary, and apply the percentage that the parent owns of that subsidiary to all retained earnings. But what you really want is, what's the difference in retained earnings from the point of acquisition to the end of the year, i.e. the post-acquisition retained earnings. So how much profit have you made post-acquisition? And then you want the parent's percentage of that. Because anything pre-acquisition, well, that's not your money. You don't have any rights over that. You almost bought that when you made the investment. So when you made the investment and bought the net assets, you're almost buying an element of retained earnings when you buy the net assets, aren't you? And then you've got that non-controlling interest, which we spoke about. That represents the equity interest in the subsidiary not attributable to the controlling interest. So the bit of the subsidiary that's not owned by you. Add all that lot up and that'll get you total equity. Yeah. Liabilities, nice and simple. Yeah. 100% of the parent plus the 100% of the subsidiary. Literally, line by line through your liabilities. Just add them up line by line. Yeah. No need to adjust anything. Just add them up line by line. If you then add your liabilities to your equity, you'll get total equity and liabilities, which should equal to total assets. So I mentioned we're going to talk a little bit about goodwill. So what is goodwill? So that standard again, IFRS 3, which talks about business combinations, defines goodwill as being the difference between the price paid for the subsidiary less the fair value of the net assets acquired. Yeah, so net assets is a fancy way of saying assets minus liabilities. Yeah. So what's the surplus of assets over liabilities? So take the value of all assets, take off the value of all liabilities, what you got left? Yeah, net assets. So it's saying what's the fair value of that? So it might be that fair value of the net assets might be £1 million. What did you pay for the subsidiary? 1.5. The difference is £500,000. So you got £500,000 of goodwill. Now, goodwill's a bit of a not a strange asset, but it is different to some of the stuff you've seen before. So goodwill is a non-current asset. Yeah, so you're not going to use up your goodwill in the next 12 months. But unlike most non-current assets that you've looked at up to now, like property, plant and equipment, it's intangible. Yeah. So it doesn't have physical substance. Yeah, you can't pick it up, touch it. Yeah. And you can't readily trade goodwill. Yeah. Now, because it's intangible, it's subject to what's known as an annual impairment review. So you're going to look at the value of goodwill each year, and if goodwill's less than what you got it reflected at in your accounts, then you're going to adjust the value through this process known as impairment. Yeah. So you need to be able to calculate a few things as part of this process. So this is not the biggest slide in the world. Depends on what size screen you're looking at it on. But if we start with the top bit of the slide, the very first thing you want to be able to work out is what are the net assets of the subsidiary at the point of acquisition. Yeah. So at the point you acquire 60%, let's say, of the subsidiary company, what's the value of its net assets? So it's made up of share capital, share premium, value of retained earnings at the acquisition date. Yeah. And then this thing called fair value adjustments. Now, there's a note at the bottom that tells you what fair value adjustment is. It's the difference between the fair value and the carrying amount of the subsidiary's net assets at the acquisition date. And the value should be added on to the carrying amount of the assets in the consolidated statement of financial position. So that's almost you saying the fair value of our office building, for example, is £2 million, but the carrying amount is only 1.5. Yeah, so you're going to have a fair value of adjustment of £500,000 because you're saying that the fair value of the property is £500,000 more than the carrying amount. Yeah, so you're going to add that value into the consolidated statement of financial position. So once you've added your share capital, share premium, retained earnings at acquisition, and fair value adjustment, you're going to get the value of net assets at acquisition. So that's ultimately the total value, or what we believe to be the total value of that business if we was going to acquire 100% of it. Yeah. So once we've got net assets of the subsidiary at acquisition, we can start to look at what goodwill looks like at the acquisition date. So at acquisition, yeah, you've got some level of consideration. So you purchased that subsidiary or that share in that subsidiary for an amount of money. So what did you give up as consideration? Yeah, whatever that amount is. Yeah. So whatever that amount is, you gave up as consideration. Yeah, that's the top line. The second part of it is the non-controlling interest. So that is, as it says in the notes at the side there, that's the non-controlling interest percentage of the subsidiary's net assets at acquisition, which is why you needed to know what the net assets of the subsidiary are at the acquisition
Yeah, it's fine.
date.
When we're still doing the college work. Can you start? Okay.
Yep, so you should be able to see that you've got the non-controlling oops. What happened there? So the non-controlling interest, yep, so that's the non-controlling interest percentage of this stuff at the top. Yeah. So you calculate the entire net assets at acquisition. That's the value as if we bought 100%. You're now going to work out how much of it did you not buy. Yeah. So how much of it do you not control? Yep. So you've got purchase consideration. So let's say £1.5 million. That's what you bought it for. The non-controlling interest. Let's say you bought 60% of the business and the net assets were £1 million. So you've got £400,000. Sorry, the bit you don't control, 40%. Yeah, £400,000 of non-controlling interest, and the net assets at acquisition, what you actually bought, yeah, was £1 million business. Yeah, so you'd have. Hopefully, I can draw on this. I think. Yep. So if you've got 1.5 million, yep. And if a non-controlling interest, this bit here, if the bottom answer here is £1 million, So that would be that bit there. So 1 million. Yeah, the bit in the middle, the non-controlling interest, is the percentage we don't own. So let's assume we bought 60%. So we don't own so the non-controlling interest is 40%. So 40% of the net assets at acquisition. The net assets at acquisition were £1 million. 40% of £1 million, 0.4 million. Yeah, so we've got 1.5 plus 0.4, it's 1.9 minus £1 million. So goodwill at acquisition, 0.9 million. So what that says is, in effect, we've overpaid for the net assets to the tune of £900,000. Yeah, so that's goodwill. Now, you need to be able to calculate what the goodwill was at acquisition, which is that bit. But then you also need to be able to say, what's the goodwill we're going to put into our group statement of financial position? Yeah. Which is the goodwill at acquisition, so that same number there, so 0.9 million. But then is there any impairment to those assets? Is there any impairment? Just remember that goodwill is subject to annual impairment reviews. So over time, you may impair that goodwill. So it's almost, that's what it was worth when we acquired that goodwill or acquired that subsidiary. Yeah. But it might be that you say, well, actually, we've overpaid, we've got £900,000 of goodwill, but actually, we just genuinely think we overpaid, and there isn't actually any value in that goodwill, so we're going to impair the goodwill. Lots of businesses do this. Yeah, so let's say that we think it was £200,000 too much, so we're going to impair it by 200,000. Goodwill that we're going to put in the group statement of financial position would be 1.7 million. Yeah. Okay, right. Don't know how I get rid of the stupid pen now, but there we go. Right. So next slide then looks at talking about that non-controlling interest in a little bit more detail. So IFRS 3, which is around business combinations, defines non-controlling interest as being the equity interest in a subsidiary that's not attributable to the controlling interest. So it's not attributable to the parent. Yep. So the non-controlling interest balance is calculated and disclosed within equity, showing the non-controlling interest holding within the subsidiary company. Yep. Now to calculate the figure, yep, the net assets working from earlier, from the previous slide, can be updated to reflect the year-end balances. So what we did before, on the last slide, what we did was this bit. Yeah, that acquisition. Yeah, what you need to do is then update it for what's the position at the end of the year. Yeah, because you don't generally acquire businesses at the start or end of year. You just acquire them at some point in time. And then at the end of the year, you need to be able to say, what's the non-controlling interest worth at the year-end date? Yeah. So it's all the same numbers. So it's the share capital, share premium, retained earnings, fair value adjustments, net assets. Yeah. And then the non-controlling interest that you're going to put into your group statement of financial position, yeah, is your net non-controlling interest percentage multiplied by the subsidiary's net assets at year end. Yeah. Now the big thing that people do wrong here is they take the non-controlling interest percentage of that number. Yeah. which is not the same as this number over here. Yeah. Because generally what changes normally in most AAT questions, there'll be no more shares, there'll be no more share premium, but that will have changed. Yeah, because they will have delivered some additional profit between the acquisition date and the year-end date. Yeah. So the non-controlling interest, seen an increase in retained earnings. Yeah. So, final sort of thing you need to be able to do and sort of understand is around the concept of retained earnings. So, up to now, you generally understand what retained earnings are. Yeah, they show profits attributable to shareholders. Up to now, you've just been dealing with one single company, so one single limited company. So it's quite simple to say retained earnings was profit built up by that company over time. At some point that profit can be distributed to shareholders by way of a dividend. Yeah. So retained earnings, ultimately retained profit, yeah, less dividends. That's what retained earnings is. Yeah. It's the same thing for groups, apart from the profits are attributable to shareholders of a group of companies rather than one single company. So as it says, it should only include the parent's share of a subsidiary's post-acquisition retained earnings, because everything post-acquisition or the parent's share of that belongs to shareholders of the group. The pre-acquisition retained earnings are nothing to do with the group, and equally the non-controlling interest share of a subsidiary's post-acquisition retained earnings are not yours either. Yeah? So in order to be able to calculate what your post-acquisition retained earnings are, the net assets working that you used a couple of slides previously needs to be updated to reflect year-end balances. So that's the same thing that we've just done on the last slide. So I mentioned the thing that generally changes is, thing that generally changes is that, yeah. So what you're trying to do is you'll say, so that's GW just group wide. Can't type with this thing. Yep. So that's just group wide acquisition. Yep. Non-controlling interest at year end date. Yep. So you're going to work out what that is. Yep. And then the difference is any movements from the acquisition date. So any movements from acquisition to the end of the year, generally with AAT exams, it is in retained earnings. So you'll see a difference there. Not to say that it can't be that these numbers couldn't change. They absolutely could. It's unlikely they will on an AAT question. It's likely just to be that retained earnings has shifted. Yeah, but you need to be able to calculate the post-acquisition retained earnings, which is the key bit you're looking at here. You don't really care about whether or not share capital, share premium have changed. Yeah, you do for other problems, but for retained earnings, you're looking solely at that line there. Yeah, what were the acquisition? What are they at the year-end date? What's the movement? And then that's what you do with it. Yeah. So the retained earnings, your group-wide retained earnings, are made up of 100% of the parent's retained earnings. So whatever that parent company's retained earnings are, all of that. And then the parent share of subsidiaries post-acquisition retained earnings. Yeah. Which, as it says in the note at the bottom, parent's percentage of a subsidiary's movement in retained earnings since acquisition. So if we go back there, you're going to get that overall movement here, but how much of that relates to the parent? So the retained earnings could have moved by £500,000, but if I only own, say, 80% of the business, yeah, then I'm only entitled to 80% of £500,000, 400,000. The other 100,000 belongs to non-controlling interest. So what's the parent's share of the post-acquisition retained earnings? And then we talked about goodwill earlier. So talked about when we're calculating goodwill, subject to an annual impairment review. If you impair your goodwill, yeah, it affects retained earnings. So the same number, the impairment, so we go back there, yeah. So you've got this impairment here of 0.2 million, yeah. That same number would appear there, yeah. So just as an example, yeah, if the parent's retained earnings were, say, 5 million, yeah, and the post-acquisition retained earnings were, so we've made £1 million post-acquisition, but we acquired, say in this case, we acquired 70%, then we're only entitled to 70% of the 1 million, so 0.7. And then earlier we said that we'd impaired the goodwill by £200,000, 0.2 million. Yeah, so we've actually got retained earnings, group-wide retained earnings of 5.5 million. Yeah. The important thing there is just to remember that impairment of goodwill affects group-wide retained earnings. Yeah, because you obviously, well, not obviously, you've got less money to distribute to your your group shareholders because you've impaired the value of the investment ultimately. Right, so they're the main adjustments you need to make. Yeah, so generally, your starting position, just add them together. Yeah, so add all your assets, all your liabilities, line by line, add them together. Yeah, and that's your starting point. Yeah, then you're going to essentially contra off the investment. So the investment that's on the parent's financial statements, cancel that against the addition of a subsidiary's assets and liabilities at the date of acquisition. Calculate your goodwill and include that in non-current assets. And then work out the net assets of the subsidiary that are attributable to the non-controlling interest. Put that in the equity section. And then work out the group's share of post-acquisition profits. And add that to group retained earnings within equity. Almost sounds reasonably straightforward to that point. But these are these things that I'm going to talk about on these next couple of slides are the things that AAT throw in there to try and confuse you. Yeah, the one thing they love to do is transactions between parents and subsidiaries. So a parent has bought £500,000 of goods from the subsidiary. So you've got receivables on the subsidiary, you've got payables on the parent. Yeah, so the parent has got a payable to the subsidiary, yeah, and the subsidiary has got a receivable from the parent. Yeah. So what it says here is can't just cancel it all. Cancel receivables and payable balances between parents and subsidiaries. Doesn't matter who's bought from who owes to who. if there's a transaction between the parent and the subsidiary, you need to cancel the effect on both sides. So cancel the receivable and payables balances in a consolidated statement of financial position. The reason being is you are now considering one financial entity. So it doesn't matter if they bought from them and they owe to them, does it? Doesn't matter. Yeah, because it's all the same entity. So you can just cancel the balances. Yeah. Where it becomes slightly more complicated is this concept of unrealized profit, or what's known as PUPs. Yeah, potentially unrealized profits. So if the parent and subsidiary trade with each other, then goods could be sold from the parent or the subsidiary, either way. That includes an element of profit. Generally, businesses sell things for a profit. Now, if the goods have not yet been sold on outside of the group, yeah, because we say if they trade with each other, the goods could be sold at a profit element. But we're going to cancel receivables and payables between the two businesses. Yeah. But if the goods are then going to be sold, let's say the parent sells something to the subsidiary sells it to the public. When the subsidiary sells it to the public, I should imagine that there's going to be profit, some level of profit there. Yeah, sold outside the group. Now that profit is regarded as unrealized because it's not yet been achieved, has it? That profit's not yet actually manifested itself. Yeah. So what it's saying is unrealized profit must be removed from consolidated accounts because right now it doesn't exist. Yeah. So unrealized profits then if adjustment if the parent sells to the subsidiary. So if the parent's selling to a subsidiary, then you need to debit retained earnings and credit inventory for the value of the unrealized profit. Yep. If the unrealized profit, if the subsidiary is selling to the parent, so it's the opposite way round, then you're going to debit the subsidiary's closing retained earnings and credit inventory. Yep. Now they're two different things because the top one, if the parent sells to the subsidiary, that affects retained earnings of the parent. Yeah, they're fairly straightforward to understand. If the second thing occurs, the subsidiary sells to the parent, it affects the subsidiary's closing retained earnings. But remember that that's not the group's retained earnings; that's the subsidiary's retained earnings, of which you as a parent company are only entitled to a percentage of those retained earnings. Yeah, you're not entitled to all of those retained earnings. So the whole problem doesn't affect, only part of the problem affects you, doesn't it? Not all of it. Yeah. Okay, so that is, I'm going to open it up for some questions if anyone's got any. I realise that's quite a whistle-stop tour through the fund that is consolidated financial statements. I realise that's quite quick, but
so when the subsidiary is selling to the parent,
yep,
you've got to do a percentage adjustment, haven't you?
Let me see if I can put an example together for you, just off the top of my head, really quickly. I probably can. You know, just I've jotted something down earlier, so let me see if I can find a good way of sharing it on the screen. Bear with me. Let me see. Let me put a whiteboard up on the screen. Hopefully this might work.
Thanks.
Did that not work? Nope, that didn't work. Right, tell you what, try a different option. Right, I'm going to draw on here. Right, so what I'm saying then is on this last slide here, so the unrealised profit, yeah. So let's assume that we are trading between the two businesses. So let's say that, which one we're going to do? We'll do the subsidiary one. So we'll do this bottom one. Yeah. So
Yeah, the bottom.
what we're going to do is we're going to say that if the selling price of these goods, let me get a pen. So let's say we've got some goods that, so got the subsidiary, we've got the parent. Yeah. So the subsidiary, yeah, has sold some goods for £120. Yeah. So they've sold them. So they've sold them. Sold for £120. Yeah. But the cost price of these goods was, well, let's say the cost price was £100. Yeah. So then they sold them to the parent. The parent bought them for, believe it or not, they bought them for £120. Yeah. But then they're going to sell them for
150.
150. Yeah. So they're
Yeah.
going to sell them for 150. So what we're saying here then is that there's a level of profit here.
Yeah.
Yeah. So
Yeah.
there's £30 of profit here. So what we're going to do is we're going to debit the closing retained earnings of a subsidiary company. Yeah. So we're going to debit.
Yes.
We're going to debit 30 into there. Yeah, and we're going to credit the group-wide inventory for £30. Yeah.
Yes.
But then when we start looking at working out what the group-wide retained earnings are, yeah, we're not taking this 30, are we? Yeah, because that's the subsidiary's retained earnings.
Yeah.
Let's say we own 60%. Yeah, the impact to the group is 60% of that 30, which is
Yes.
18.
Yeah, it makes sense.
Yeah. Whereas up here, yeah, if we did it the other way round, yeah. So if I did it the other way round, and that was the, let's say that's the parent, and that's the subsidiary. Yeah. Then the retained earning, all of that belongs to the group, doesn't it? Because it's the parent that's where the unrealised profit belongs to the parent company.
Parent.
And we own all of the parent company because we are the parent company. Yeah. So it's always a debit. So it's always a credit to group inventory, but the debit depends on whether or not it's the parent selling to subsidiary or the subsidiary selling to the parent. If it's a subsidiary, then subsidiary selling to parent, then it affects the subsidiary's closing retained earnings.
Yes.
Otherwise, it affects the parents.
The parents, yeah. I get now.
Yeah.
Thank you.
No worries. Impairment of goodwill to affect group, not the retained, the non-controlling interest. Yes, absolutely, because it's because ultimately goodwill is you've acquired a percentage share of that business for an amount of money. So you've given up consideration. So you've valued the net assets, all of them, as if you're buying 100%. Yeah, and then you're buying probably easier if I just share a slide. So if we look at non-controlling interest there, yeah. So the question was around, one day I'll work out how Teams works. So the question was something around whether or not it affects, in fact, let me just find the question and then reshare. Does impairment of goodwill affect group? Not, yes, right. So let me show you with the slide exactly what you mean there. So impairment of goodwill, yeah. So it's this bit at the bottom here. So it only affects two things. Yeah. So the impairment there only affects goodwill. Yeah, it affects in the group statement of financial position, because ultimately what you've done is you acquired a percentage of that business. So you've worked out what the net assets of the subsidiary are, the whole thing. You've acquired 60% of it. Yeah. How much did you pay for the 60%? Well, I paid 1.5 million for 60%. So I paid 1.5 million pound for 60% of something that's the whole lot's only worth £1 million. So in simple terms, you almost don't need this bit here, because you paid 1.5 million for 60% of something worth £1 million. So how much have you overpaid by? £900,000. Yeah. These bits in the middle are quite useful to work out what's the value of the non-controlling interest. So 40% I don't control. What's the value of the net assets? Yeah, that's the 400,000. And then what's the total value of the net assets? So then impairment, because impairment is a group-wide problem, not the non-controlling interest problem, because the non-controlling interest are not buying the goodwill, are they? The parent's buying the goodwill, they're buying the business, and they're overpaying for it potentially, and that's what creates goodwill. Yeah. So yeah, it's a group issue, not a non-controlling interest issue. Don't seem to be able to get the chat and the slides on at the same time, hence why I keep jumping between the two. Okay, any more questions? What I would suggest people do is to practice, like look at, if you're doing level 4, look at your training provider materials. There'll be plenty of questions around consolidated statements. There's almost almost three big things on this unit. One is single limited company accounts. So can you produce all the statements for a single limited company? Can you do consolidated statements? And then all of the various accounting standards around things like impairment, leases, property, plant and equipment, so non-current assets, and all the various other accounting standards that are covered on the unit. If you understand the three things, you'll definitely pass the exam. It's they're the three key things on the exam. There's really, I say there's nothing more to it. It's a big unit. Don't get me wrong. There's an awful lot to it. It's arguably not as big a unit as applied management accounting, and I think it's much more learnable, if that makes sense. So I think it is easier to learn the structure of consolidated statements than it is some of the stuff in the applied management accounting module, in my opinion. I think it's easier to get a higher mark on this than it is applied management accounting. Very much just a process, but everybody's different.